Mike Tedeschi, Wealth Management Advisor with Prospective Wealth Planning, and this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We'll jump in and take a look at the U.S. dollar as well as commodities. And then we're going to take a look at forward PE ratios against the VIX. A very interesting data set there. And we're going to pay attention to what insiders have been doing here over the last couple of months. You're probably going to find it pretty surprising. So let's jump right into it here. Four major indexes, not a whole lot additional to discuss than what we've done here over the last few weeks. We have our breakout here on the S&P 500 a few weeks ago, right in here, and we have continued to head higher. We continue to make new highs almost every single day here for the last couple of weeks. We had a little bit of a pullback here in the beginning of the week. We made a nice little bounce, and we're right back up at those all-time highs once again on the S&P 500. We take a look in at the NASDAQ. The NASDAQ put in a new all-time high. Very similar type of chart there. We take a look at the Dow Jones, very similar type of chart. Breakout back test continues to push forward, making new all-time highs, is right up there at that high zone. And the Russell, when we take a look at it here, is the only index that really hasn't been accomplishing much here over the last couple of months, but it's just a nice little trading range. There's nothing bearish here. It came from below, so usually when you come from below and go into a pattern like this, you have a higher propensity to make a breakout than you do a breakdown. However, regardless, we are going to pay attention to see which direction we leave this range from. We had just an incredible thrust at the end of last year, moving sideways for a while, kind of working off that overbought condition that we saw in the beginning of the year. Would be perfectly normal and perfectly healthy, but we'll continue to pay attention to the Russell because it does have a decent gauge in terms of risk on, risk off behavior. But right now, even though it's not pushed up to new all-time highs like the other three indexes, there isn't anything concerning about it at all here. Now, let's take a look in at the U.S. dollar. The U.S. dollar fighting right at this key level. Look, we've had these lines drawn on the chart for years, and I'm not going to change them. The 91 level has been really, really important when we go back to 2017, right in here. It was a very, very important zone. It is a very important zone once again here this year. We had that bounce up, and remember what we talked about. We did not make a higher high, so the downtrend is still in play. So we're really watching what's happening right here. This very easily could be a bear flag for the U.S. dollar in that downtrend over the last year. Nothing is confirmed at this point. We're still paying attention to those key levels, 89, 91, and right up here around that 93, 94 zone. So we'll keep watching this and keep you guys updated on it. Crude, still fighting in that zone. It's been there for a few months now, in between that 56 and that 70 zone, trading sideways. We don't have anything bullish to say. We don't have anything bearish to say. We are just kind of in waiting mode to see where that next move in oil is going to be, either up or down. We know where our key levels are, and we're going to continue to watch them. Gold, and we talked about it last week. I said we wanted to be up over 1776. We got up over that zone. Now we need to start looking at some upper resistance levels that we've got here. We have 1800 as the next it's like 1811 is that next high that we're paying attention to, and then it becomes 1880. So we'll see if we can't get up over this 1811 zone, then target up towards that 1880. On the downside, has to hold these lows here around that 1650 zone. If it doesn't, again, I've said it before, I'll say it again, that would change my outlook for the space if gold were to make that breakdown. We take a look at silver, holding up much better, held on to that 23 support, making a bounce. It is right at a very important level. It's about that 2675 zone right here. A move up above that would target that 2850 level there on silver, so we'll keep watching that. Platinum is acting well. We had that breakout. We have put in a little bit higher lows here over the last couple of months, making a nice little pattern. I'd like to see this back up over 1250. Now, palladium finally makes that breakout. We've watched it, we've talked about it, and that 2800 all-time high zone, we pushed over it here, and the first day after we pushed over it, I'll zoom in so you guys can see it a little better, had a nasty little reversal there, but the following session got back up cleanly over that 2800 level and now looks to continue to be pushing, so that is a very bullish look there. Out of palladium, copper is acting well. It's almost back up to those highs. Again, when we back this chart up, when we look at it from a multiple year perspective, let me back this up on a monthly for us, right? We're almost at those all-time highs. So what happens here over the next couple of months, right into this 450 zone in on copper is going to be very, very important. We're going to continue to watch that very closely. Now let's jump in and let's take a look at some valuations. First, we're going to talk about the Case-Shiller PE ratio. This chart, if you guys can see here, does go back all the way to the 1800s. So this is a long time look here at the Case-Shiller PE ratio on the S&P 500. The average price that we see historically over the last 150 years is right around that 16 level. All right, we're trading up at a 37.5. Now, we've looked at this before in the past, and I've said it for the last few years. This is not a reason to be, oh my goodness, the world is ending because we're so much higher than our normal average. One, central banks have printed money in a way that they never have before, so that certainly leads to inflation and can certainly lead to this number continuing to increase. But we've been over the average now for years, and the market continues to trend higher. This is one of those things that doesn't matter until it does. The reason why I wanted to bring this up is I wanted to put the PE ratio in context with what the VIX is doing, so how traders are hedging. Now, this is just the forward PE ratio here on the S&P 500, but when we take a look at that spread against the VIX, we're at one of the highest spots that we have ever been. This goes, over the last few years. And this is also historically at a very, very high rate. Now, this chart here goes back to 2018. I'm going to take a look now back until 1990. As you can see, we only have a couple of times in the last 30 years we've been higher than this. Now in 2016 and 2017, that started that big move up. Every other time we've kind of run into this zone, it hasn't bode well for the markets in the short term. All right, because what this is saying is the forward guidance essentially for the S&P 500 companies is so much higher than normal compared to the volatility that traders are priced in. It's almost like everybody thinks that things just have to keep getting better and better and can't go sideways or down. And usually when everyone is on one side of the boat like that, that precedes some very choppy times. We're going to look at this in two ways. We're going to take a look at this as the S&P 500 when we have the PE and VIX spread over that 6.5 level. There's not a ton of data signals here. All right, there's only a few, but 2 to 3 months out, historically, it's been pretty bad for the market, with only 1 out of 5 actually being positive, and that was in that 2016 push. All right, risk to reward is a little bit skewed here in the bear's favor, but one of the other ways that we can look at it is the S&P future PE ratio. So this is not the S&P 500 itself. This is the S&P 500 forward PE ratio. You can see 2 to 3 months out, 100% of the time that multiple has dropped. All right, 6 months out, 20% of the time it was positive. That is basically saying that at some point here over the next few months, historically, when the PE ratio has been as high as it is, that starts to pull back. That doesn't always mean that the market pulls back with it. We can have a couple of things happen, right? We can have the PE ratio expand to the upside, okay, against the S&P 500, which could cause prices to continue to go up. This is just a very interesting data set that we wanted to take a look at. Basically, the market is pricing in, at this point in time, really, really strong future growth. Not a lot of people are hedging against that. That's something we've talked about in the past. Now we're going to take a look at the scariest data set that we've looked at in quite some time. And this is taking a look at what insiders are doing. All right, this chart here goes back to 2006. The ratio of insider sales to buys at this point in time has never, ever even been close to this. It's 2 times higher than the normal peaks, right? And usually our average is down here. We're about 7 times higher than normal. Insiders are dumping their stock positions at a rate that they've not done in the last 20 years. And that's really concerning, right? One of the things we like to pay attention to from an insider standpoint is when buying from insiders is going up, that usually means insiders inside industries see fantastic growth, they see fantastic futures for their companies, and they put their own capital behind that and make the bet that things are going to continue to go well. When we have a high percentage of insiders selling, versus buying, that usually means that they think that we're getting at a point in time where markets are fairly valued, the growth potentials are diminishing, things aren't really necessarily looking as rosy over the next few months, and they want to take some chips off the table. Now, what I will say with this is we did have insiders making large amount of sells versus buys, again in that 2016-2017 expansion, and we also see it once again in 2010-2011. So it doesn't mean that the market is just going to roll over at all, right? There's a lot of reasons why they could be taking some chips off of the table, but this is just such an outlier in terms of the percentage difference between normal spikes and what we're seeing right now that it is definitely eye-opening, and it's worth paying attention. And this goes across many of the different sectors. So materials, discretionary, financials, all of them are seeing a large corporate insider sell rate versus buy rate at this point in time. This is something to certainly pay attention to here in the near term. Again, when we look at all of these data sets, these are just things underneath of the surface that we need to be concerned about, that we need to continue to pay attention to. But what speaks more than anything else is price. And when we look at the S&P 500 and we look at where we're at all-time highs. Being at all-time highs is not a bearish thing at all. Under the surface, there are certainly some areas for concern, but as long as price continues to rock and roll higher, we can kind of ignore those things. As soon as our charts start telling us a different story where, the S&P 500 maybe breaks back below 4,000, then some of these other things that we've been talking about might hold a lot of weight. Until then, let's continue to pay attention to our price action. As always, I hope you guys have yourself a fantastic week. If you guys have any questions, you want to reach out to me directly, you can reach me at mtedeschi@perspectivewealthplanning.com, or you can give me a call at 814-580-9881. I'd be more than happy to talk anything with you guys in regards to the markets. I'll see you guys next week. Take care.